Hello everyone. Welcome to today's video on mastering the interest coverage ratio, ICR. This ratio is a key metric used by investors to evaluate a company's financial health and its ability to meet debt obligations. Today, we'll delve deep into what it is, how to calculate it, and its implications for making smart investment decisions. To begin with, let's define the interest coverage ratio. The ICR is a financial metric that measures a company's ability to pay interest on its outstanding debt with its earnings before interest and taxes, commonly abbreviated as EBIT. The formula for calculating the interest coverage ratio is quite straightforward. It is ICR equals EBIT / interest expense. Essentially, it tells you how many times a company can cover its interest obligations using its operating earnings. For instance, if a company has an EBIT of $200,000 and an interest expense of $50,000, the ICR would be 4. This means the company can cover its interest payments 4 times over with its operating income. Why is the interest coverage ratio important? This ratio provides insight into how well a company can meet its financial obligations. A higher ICR indicates that a company is in a better position to meet its interest payments, thus posing less risk to investors and creditors. Now, let's illustrate this with a more detailed example. Suppose Company A and Company B both have EBIT of $300,000. However, Company A has an interest expense of $50,000 while Company B has an interest expense of $100,000. Let's calculate their ICRs. As you can see, Company A has an ICR of 6, and Company B has an ICR of 3. This indicates that Company A is in a better financial position to cover its interest expenses compared to Company B. Next, let's delve into some questions you might have about the interest coverage ratio. Question 1. What is considered a good interest coverage ratio? While it depends on the industry, as a general rule of thumb, an ICR above 3 is considered good, indicating that the company can adequately cover its interest expenses. An ICR below 1 is a red flag, suggesting that the company cannot cover its interest obligations. Question 2. How does volatility in EBIT affect the interest coverage ratio? Changes in EBIT, whether due to fluctuating revenues or expenses, will directly impact the ICR. High volatility can make it harder for a company to consistently cover its interest payments, which is something investors must watch out for. Now, let's visualize how a sudden drop in EBIT impacts the interest coverage ratio. Imagine Company A's EBIT drops from $300,000 to $150,000 while maintaining the same interest expense of $50,000. You can see that the ICR drops from 6 to 3, showing how sensitive the ratio is to changes in EBIT. Lastly, let's discuss how the interest coverage ratio can affect investment decisions. A high ICR suggests that a company is financially stable and less risky, which might attract conservative investors looking for safe investments. On the other hand, a low ICR could indicate potential financial trouble, deterring investment unless the investor is looking for higher risk-reward opportunities. Let's summarize today's lesson. The interest coverage ratio is a critical tool in assessing a company's ability to meet its debt obligations. By helping investors understand the financial stability of a company, it facilitates more informed and intelligent investment decisions. Thank you for watching. Don't forget to like, share, and subscribe to our channel for more finance tutorials. See you next time.